You wouldn't go shopping without knowing your budget. That's exactly what a mortgage in principle does. It allows you to understand how much you can borrow, what you can buy at, potentially what your monthly costs are going to be, but importantly, it gets you through the door with estate agents and allows you to make offers on properties. So in this video, we're going to cover off all the things you need to know about a mortgage in principle without any fluff, trying to avoid any jargon. I'm Lewis Shaw. I'm an independent mortgage broker. I've helped over 1,000 buyers over the past 10 years. I've got plenty of 5-star reviews to go with my name, and I'm regularly quoted in the press. So if you're here to understand about mortgages, you're probably in the right place. So let's get into it. So the first thing is, what in fact is a mortgage in principle? In reality, it's just a piece of paper. It's a piece of paper that the bank says, yes, you can borrow X amount of money. Now, it's important to understand that it's not a guarantee of a mortgage. It doesn't say that you're going to get approved, but what it does do is says you are on the way to getting approved. And it's the key part that some first-time buyers can kind of sometimes overlook. But it's actually the most important part of the mortgage process. Because without it, can you actually evidence that you can buy anything? Probably not. So, how do you get a mortgage in principle? Well, this is relatively straightforward, but first, let's bust a bit of a myth. Probably when you're scrolling on Facebook or Instagram or TikTok or wherever it might be, or looking online, thinking about buying your first home, you'll come across these sites that say, get a mortgage in principle in 5 minutes or 15 minutes or 90 seconds in some cases. Now, the important thing to understand here is that mortgages in principle are only as good as the information that goes into them. So if you say, I earn £100,000, but you actually only earn 50, then clearly it's not going to be particularly worthwhile doing that. It's not going to be accurate, so there's no point. Now, that's a really obvious mistake to make. I'm sure you wouldn't actually put down you earn £100,000 if you earn £50,000. But one of the things that I've noticed over the past decade of doing this job is that often people aren't always sure of actually how much they earn. And when I say that, you probably think, well, of course I know how much I earn. But in fact, the level of accuracy that you need to have when it comes to declaring your income to a mortgage lender has to be specific. So when someone says, I earn £25,000, is it actually £25,000 or is it £24,983.22p? Because that's the level of accuracy that a lender wants to know. If, for example, you've got £1,000 outstanding on a credit card, is it £1,000 or is it £982 or is it £1,131? That's the level of accuracy that you need to have when it comes to getting a mortgage in principle. So, the myth bust is, don't believe this kind of stuff that says you can get a mortgage in principle in 90 seconds or in 10 minutes. The reality is, they're not particularly useful because the point of a mortgage in principle isn't just to get a lender's, some note paper with a lender's name on the front. It's in order that you can move forward buying a home with confidence. And given that it's only as good as the information that goes into it, and if no one's there checking your documents, what's the point in doing it? So let me just kind of talk you through how you should go about getting a mortgage in principle. So there are two parts to it. There's getting your questionnaire done and supplying your documents. So the questionnaire is what we call in the trade a fact find, which is just a questionnaire, but it's quite detailed and it's going to go through things like who you are, what's your legal name, your date of birth, your contact details, importantly, your address history. It's going to ask questions about where you work, what's your employment type, are you employed or self-employed, how much do you earn, how much does that mean as a net income? Because of course, if you've got student loans or pension payments coming out of your pay packets, that needs to be taken into account too. So that's the questionnaire part. Basically, it's all about you, your circumstances, and what you're looking to do. How much deposit do you have? How much are you looking to borrow? Where are you looking to buy? How long have you been in your job role? All those kind of factors. That's really what we call hard facts. So we can distinguish hard facts between soft facts. Hard fact is evidenced by a document. What you say you earn is evidenced by a payslip. Who you say you are is evidenced by a passport or a driving license. What you say you spend is evidenced by your bank statement. So that's a hard fact. Then we have what are called soft facts. That's the actual bit about you. What do you like doing? Do you have a horse? Do you enjoy going clubbing? Do you want to go skiing once a year, etc.? So the soft facts are a bit about you. What do you like to do? What's your kind of pastimes, your hobbies? Because that tells us quite a bit about you, actually. So we distinguish between the hard and the soft facts. And then we get your documents. Now, if you're getting an agreement in principle and you're not actually supplying the documents, you might as well just not bother. That's the reality, okay? Because, as I mentioned at the start, they're only as good as the information that goes into them, which is why, to do it properly, you should generally speak to a mortgage broker. And of course, I'm a mortgage broker. I get paid for this. I'm not unaware of that. So clearly I'm going to be a bit biased. But realistically, the only way to know exactly how much you can borrow is by going through that process. So when it comes to documents, what are we talking about? Well, the first thing is, of course, ID. Can you prove who you are? So passport, driving license. Are they valid? Are they in date? Are they in the right name? Importantly, for a driving license, is it at the right address? Just as an NB, you might not know, but if the address on your driving license is incorrect, it's a previous address, it's not actually a valid piece of ID. And you could be fined £1,000 by the authorities. So just check your driving license. Even if you're not buying a home, probably check it now. And if it's not the right address, update it, please. So the first part's the ID. The second part then is around income. Now, if you're employed, that's relatively straightforward. We just ask for your last 3 months' pay slips. Why the last 3 months? Well, it's relatively straightforward. That's what mortgage lenders consider to be representative of your average income. Now, that does change, of course, if you're getting lots of overtime or maybe you get bonuses and commissions. But as a rule of thumb, we're just talking about basic income here. So it would be 3 months of pay slips. Now, if you're paid weekly, that's 13 weeks because that's a quarter of a year. If you're paid 4 weekly, it would generally be 4 pay slips because that's slightly longer than 3 months. So you get your pay slips in. And what are we looking for on the pay slips? We're looking at, of course, your gross income. We multiply that by 12 or 52, depending on how often you're paid. Of course, if it's 4 weekly, then by 13. And that gives us your annual income. And then we're looking at net pay. So what do you have going out? Pension payments, student loan payments, share save schemes, etc. So we're getting your pay slips in. And then we're going to ask for your bank statements as well. Now, it's important to understand that bank statements aren't just about your spending. Bank statements actually verify what you earn. Why? That sounds a bit odd. You'd think it would be pay slips, but in fact it's not. Think of it this way. If you received a pay slip, but the money hadn't gone into the account, you wouldn't consider yourself to have been paid. But if your money has gone into your bank account, but you didn't get your pay slip, you would have been paid. It's actually your bank statement that verifies your income and not the pay slip. That's really for accounting purposes. So then we get 3 months of bank statements, and that covers the same period of time for the pay slips. Why is that? Well, one of the things we have to do as checks, as mortgage brokers, is we have to match up the money on your pay slip to the money on your bank statement to make sure that that's all legitimate and sound. And then we're also looking through your spending patterns and habits. Now, this isn't something to panic about. It's just part and parcel of the job. And we get questions all the time. What if I spend some money on betting? Or maybe a bit of a spicy side? Now, as long as you don't have an actual massive problem, as long as you're not gambling, tens of thousands of pounds a month, then it's not an issue. And the odd subscription here or there, we might have a giggle about it, but in reality, you'll be fine. So we've covered off there ID, pay slips, bank statements. What's next? Well, the fourth thing is proof of address. We need to be able to prove where you live. And particularly for first-time buyers, this can be a challenge because if you're living at home, maybe with your parents, then the chances are you're not on any utility bills, you're probably not on the council tax bill, etc. So what can we use? Well, we can use bank statements. We could potentially use insurance documents if you've got car insurance. Ideally, we'd go with bank statements, but the best thing really is your driving license. ID for ID, so passport for ID rather, driving license for address, happy days. And the final piece of the puzzle is your credit report. Now, this is something that people often panic about when it comes to credit reports. It's nothing to worry about. We all get really hung up on this number, the score. Oh my word, my score's this, my score's that. Genuinely don't get hung up about it. You can't change them quickly. Well, you can, I suppose, if you won't go bankrupt, they'll go down very quick. But the reality is you can't change them very quickly. But you know what? They are what they are. And mortgage lenders aren't too concerned about the score, the number that you see. They're really not that bothered. They're bothered about your conduct. They're bothered about how you've managed finance, how you've managed debt. They're also bothered about whether you're on the electoral roll. So here's a quick tip to improve your credit score. If you're not registered on the electoral roll, get on there. It takes all of 30 seconds. You can jump online, apply to register on the electoral roll, you tap your details in, hey presto, it's done. Now, it can take kind of 6 to 8 weeks for that to show up on a credit profile, but once it's done, it's done. And one of the reasons that's important is mortgage lenders use the electoral roll data as part and parcel of their ID check. So we've covered off there what documents you're going to need if you're employed. Now, it is a little bit different if you're self-employed, and it depends whether you're a sole trader or whether you're a limited company. If you're a sole trader, it's normally going to be things like tax calculations and tax computations and tax year overviews rather. And if you're a limited company director, it's going to be tax year overviews, tax computations, and your accounts more than likely. But we'll cover off that in a separate video. So we've got your documents in, we've got your questionnaire in, and now what do we do? So as a broker, we now sit down and kind of go through all the data that we've got in front of us and work out how much you can actually borrow. We then jump onto what's called a sourcing system, which is where we're looking at how much you might want to borrow, how much you are able to borrow, and then selecting a lender. Now, this is the bit of the mortgage in principle that sometimes confuses people. When you get a mortgage in principle, as I mentioned, it's not the guarantee of a mortgage offer. It doesn't, in most cases, lock in an interest rate. But what it does do are the following things. It's doing an ID check, it's doing an affordability check, and it's doing a credit check. Now, the credit check part of that is what people panic about, and they normally ask the question something along the lines of, is it going to damage my credit profile? The answer is, in most cases, no. So, just to highlight this, there are two types of credit check. There's soft and there's hard, or you might hear it as soft footprints and hard footprints. So let's distinguish between those. So a soft footprint is basically saying they're going to do a credit check, but it's only visible to you. So when you look on your credit report after an agreement in principle has been done, you'll see that X lender has done a credit check. But you can see that on your credit report. But then if you go to the bank next door, they can't see that that bank has done that credit check. That means it's soft. It's not detrimental. It won't harm you. Now, the vast majority of mortgage lenders do use soft credit checks. So that's useful. Now, the alternative to that is what's called a hard credit check or a hard footprint. That's where points will start being knocked off and it is a proper stamp on your credit profile. And that means that if you do a hard credit search, if you then go to lender B, they're going to be able to see that. You'll see that, they'll see that, they'll see that, and they'll see more than likely that it was for a mortgage. So that's the difference between the two. So we do the credit check, or the lender does that kind of worrying about in the background, and then, hey presto, ping, or assuming everything's right, it gets approved. Now, why is that important? What's the actual purpose of a mortgage in principle if it's not going to guarantee a mortgage, if it's not going to lock in a rate? Well, it's simply because if you're out there home hunting and you want to be taken seriously as a buyer, you need to be able to evidence that you can actually buy that property. Put yourself in the shoes of a seller. Imagine you've got a home, you put it on the market and you're wanting to move home. And you know that you've got to get an estate agent in, they're going to put it on the market, and then you're going to have how many other people traipsing through your home day after day after day, potentially for weeks on end. It's not unreasonable for a seller to expect that you can have actually evidence that you can move forward with the purchase. I mean, imagine if you were selling your home and people were kind of drifting in and out, and then all of a sudden you found out that half of them had not done any prep work. You had no idea whether they could actually buy your home. You'd probably be a bit cheesed off. So it evidences that you're a serious buyer. But not only that, the real benefit to a mortgage in principle, and this is what is often missed, is not that it gives you the ability to make offers. It's not that it gives you the confidence that you'll actually get approved for a mortgage when you find the right home. It's that it stops any nasty surprises from cropping up. Because the amount of times that I see documents where, because of course we all move around, so let's say you've been at university or maybe you're living with a friend. The amount of times I see where the pay slips are registered to the wrong address, the driving licence has got the wrong address on, bank statements are at maybe mum and dad's. Payslips are registered to grandmas. So the real purpose of a mortgage in principle is to do the prep work so that you know what you need to do, so that we can check the documents, so that we can spot any errors before they become a problem. Because the last thing you want is to find the right place, negotiate the price, get it all agreed, only then to find, oh, actually, that mortgage lender that's got that really great deal and that really great rate, they're going to reject you because your documents are all over the shop. So that's one of the real big benefits of a mortgage in principle. Let me stop that. So, in terms of how much deposit you're going to need when it comes to getting a mortgage in principle, generally, it doesn't actually matter. What matters is that you have a deposit and that we can evidence it. So, when it comes to getting a mortgage in principle agreed, of course, the bigger the deposit, the easier it is. That goes without speaking, right? It's less risk for a lender. It's better for you because you get a better rate. But don't panic too much about your deposit. What really matters is, have you got a stable address history? Have you got a stable work history? Have you managed your credit on time? They're the things that matter. Not all the other kind of stuff that you might see online about this hack for that and that hack for that. This stuff is actually really simple, but it's made hard by not doing the basics right. And the basics are making sure your documents are in order, making sure your ID is valid, making sure you're on the electoral roll, and keeping your nose clean with credit. Now, look, not everyone can do that. Some people have mistakes on the credit profile. Some people have had a history of where they've not managed to keep up to date on everything. Okay? Now, don't let that put you off. Now, the amount of people that I speak to that are terrified of the credit profile is astounding. And I think it's made worse by a lot of people in the press kind of harping on about this stuff quite regularly, to be fair. But realistically, the only way to find out is to do a decision in principle and then see what it comes back with. Okay? So if you're thinking about buying your first home, don't be using these kind of online things that say you can do it in 90 seconds because, as I say, you might as well just not bother. You genuinely might as well just not bother. If they're not checking your documents, if they're not going through a proper fact find, if they're not having a conversation about how much you want to borrow, how much you can afford, and what it might look like as a cost, you might as well not bother. Now, why is that? Well, it's simple. As I mentioned earlier, they're only as good as the information that goes into them. And I know I'm going to keep labouring this point, but it's for the simple reason that I've done this for so long and it makes such a difference to be able to get all that stuff done right at the start. And then I promise you, the rest of it, I mean, it's not easy because you've got to contend with solicitors and surveyors and estate agents and all the rest of it. But there's nothing worse than finding the right place and then not being able to move forward. So, move on to the next point. What are some common pitfalls with mortgages in principle, both from getting one, but also misunderstanding what they are? Now, it's important to understand that when you get a mortgage in principle, let's say it's with lender A, it doesn't necessarily mean that's who your mortgage is going to end up with. It might be lender B or lender C or lender D, or all the lenders that are, start with H. But what it does do is it gives you a good idea that you will be approved. So once you've got that mortgage in principle, that's in your back pocket, crack on, find the home, negotiate the price, away we go. But just because the mortgage in principle says, for example, Halifax at the top of the paper, and of course other lenders are available, just because it says that doesn't mean that's who your mortgage is going to end up with. But normally it'll be the case that when we looked to get the mortgage in principle, they were probably the best lender at the time. So it's important to understand that that's the case. Now, in terms of pitfalls, realistically, if you do what I've mentioned throughout this video in terms of checking documentation, making sure ID is correct, there aren't many to fall down, other than this kind of nonsense of get one in like 30 seconds. But one of the big pitfalls of mortgages in principle is it's only as good as the information you give us. So it's always best to be really, really honest and upfront with your broker. Because if you're not, and you don't tell us something which does later come to light, that's when problems can occur. So in terms of pitfalls, not disclosing everything. And that includes kind of deposits and things. So Of course, cryptocurrency these days is really big. Lots of people have got crypto investments or mess about on kind of exchanges trading crypto here and there. The vast majority of mortgage lenders, it's like their kryptonite. So, for example, if any of your deposit is coming from cryptocurrency, you've definitely got to disclose that, because there are a couple of lenders that will be okay with it, but if we don't know, we can't know about it, and then we can't take account of it. So that's one pitfall, not disclosing deposits. The other pitfall is not being honest about your income. Now, what do I mean by that? And it's not about necessarily being honest, but it's about making sure that the information that we get is accurate. You've got to understand that a mortgage lender can do as many checks as they want. After all, it is their money. And if we tell them something, they do have the power and the wherewithal to check it. So if you say, I've been working at company X for 2 years, and they for some reason think, we're just going to send a reference out, we're just going to check this, and it turns out you've been there for 4 months, that's going to cause a problem. Not because they would have declined it, but because you've not been honest. So pitfalls are, don't use these kind of crazy, really, really short distinctions in principle, they're meaningless. 2, make sure you're always honest about everything you declare to your broker, or if you're doing it yourself directly with a bank, with a bank. So, in terms of how to choose the right lender when it comes to the mortgage in principle. Now, this depends on a few factors. 1, how much are you looking to borrow? Because, of course, every single lender has their own affordability calculation. Do you need to borrow 4 times your income, 5 times your income? 6 times in some cases is even possible. Now, it's not quite that simple, and I'm going to do another video on affordability that covers all that off. But every single lender has their own calculation as to how they will assess your income, your outgoings, and how much you can borrow. And one of the mistakes that people make is always searching for the cheapest rate. Now, I know that sounds odd, but let's say there's lender A, and they've got this really, really stupidly good deal. Now, often what comes with really stupidly good deals is quite tight lending policy and probably quite strict credit scoring. That's one of the reasons mortgage lenders can offer such cheap rates, is probably because they don't take any risky business on the books. So part and parcel of that might be that also their affordability might not be that great. So it's about establishing what your needs are. It's about establishing how much you need to borrow. Now, if it's a case that you've got tons of income, no debt, no children, and everything's really kind of vanilla and straightforward, then yeah, you can pick from the list and away you go and you'll be fine. But most people aren't like that. Most people do have some debt. Not everyone's credit profile is perfect, because now people are renting and kind of moving every 6 to 12 months. Address histories aren't always that stable. So it's important to obtain the mortgage in principle from the best lender that's available at the time. Now, how do we determine that? We go through your documents, we go through the questionnaire, we ask you some questions, and then we obtain it. Now, one question that often gets asked is, how long does a mortgage in principle last? Now, the answer to most things mortgage related is, unfortunately, it depends. However, a good catch-all is 90 days. The vast majority of mortgages in principle are valid for 90 days. Some are 60, some are 30, some are even shorter than that. But if it's a mainstream lender, you can bet your bottom dollar it's probably going to be 90 days. And then after that question comes, well, what happens if I've not found a property in 90 days? Don't panic. To renew it takes all of 30 seconds, if that, assuming nothing's changed and you've not going to go a CCJ, it'll be fine. Now, what happens if you find a home to buy, you've had your mortgage in principle agreed, and then for some reason your mortgage application gets declined at application? That's a question I get asked quite a lot. Now, the reality is very, very few and far between that will happen, because when lenders are doing these checks, they're very thorough. They're doing tons and tons of kind of different data analytics in the background. They've got tons of information. They've got access to the credit profiles. They're running all that kind of stuff, and it's whirring away in the background. Realistically, I'd say probably less than 1% of people that I've helped buy a home have ever got to the point of making an application and it declines at that point. So don't let that panic you. Don't let it put you off. And don't be scared of these credit checks. They're genuinely not that big a deal. That's not to say you should be doing 10 a day. Don't do that, for God's sake. But they're really not that big a deal. Okay? So, next piece, deposit strategies. Why is a deposit strategy important for a mortgage in principle? Well, it's kind of not. But here's the thing. In order for the decision in principle to be accurate, we need to know how much you actually have as a deposit. Because there's no point applying for a mortgage in principle that's 90% loan to value, which means you've got a 10% deposit, if in fact you've only got 5%. Equally, there's no point applying for a mortgage in principle saying you've got a 10% deposit if you've got 25%, because that will change the way that we search for the right lender, it will change the way that we search for the right product, and it will probably change the amount that you can borrow as well. So that's why having your deposit already saved is really important before you start looking for a home. Now, that will go on to, again, I'm going to say this quite a few times, I suppose, that will go on to a different video about how much you need to borrow, how much you need to save up in order to get the best deals and all that kind of stuff. I'll cover that in a different video. But it's important to have the deposit saved up at that point. Now, sometimes I'll speak to people and they'll say, but I'm not looking to buy for a year. Generally, the best piece of advice is don't sweat the stuff now then. Just save up, pile the money into your lifetime ISA if that's where you're saving it, or into your savings account, or, tap your parents up if that's even possible, and come back to me in 12 months. Because the mortgage market is dynamic. It changes over time. And what's true today doesn't mean it's going to be true in 12 months. It doesn't even mean it's going to be true in a week. Now, it probably will be true in a week, but we don't know. Interesting fact here, in one weekend during the pandemic when COVID first kicked off, there were 500 policy changes in 48 hours. Imagine having to relearn all that. Absolute nightmare. Anyway, I'm getting carried away with myself there. So, we've covered off what documents you're going to need, why it's important to not get sucked into this nonsense about doing it in 5 minutes or 10 minutes or 15 minutes. Yes, when I'm doing decisions in principle, the actual process of me getting one takes about 2 minutes. But the preparation, there's no way that anyone can assess you properly so that you can know with confidence, that this is going to be accurate. And when you're doing something like buying a house, which is a massive decision, and you're going to be borrowing potentially hundreds of thousands of pounds over the next Christ knows how many years, it's not something to scrimp time on. We live, I guess, in a bit of an age where everything's on our phone, isn't it? I can go on now on my phone and I can probably apply for a credit card and get approved for whatever limit in about 10 minutes, probably less. I can book a flight. I could book a viewing for a house. Don't fall into the trap, however, of using this when it comes to the biggest debt you'll ever take on. Take the time, do it properly, get it right, and I promise you'll have a much easier time when it comes to buying a home. Now, there is, of course, tons more I could talk about decisions in principle and mortgages in principle. In fact, I will say this. DIP, AIP, agreement in principle, MIP, mortgage in principle, it all means the same thing. It's just different jargon. This industry is absolutely full of jargon. They all mean the exact same thing. So don't worry about that. But hopefully that's given you a bit of an insight into what you need to do, the documents you'll need to provide, what actually happens, and why it's important. Now, of course, if there are any questions, you can drop them in the comments. I'll answer them as and when I can. And if you do want to get a decision in principle or a mortgage in principle or an agreement in principle, I'll use all three there, then feel free to get in touch. Now, importantly, I don't want this channel to be some kind of sales pitch or anything like that. I am a mortgage broker, obviously, and I am authorised by the regulator to give mortgage advice. But this is more about helping people. But of course, if you do need help, then you can get in touch. But don't feel obligated, for God's sake. So I'm going to love you and leave you. Hopefully that's been useful. I know it's been kind of short and sweet, but I'll hopefully see you soon for another instalment of Mortgage Talk, and we can take it from there and see where we go. Look after yourself.